Hello and welcome everyone to the week ahead commodity report, where we of course will be reviewing the markets for the week ahead. So first of all, what do you need to know as we go into next week? Well, hedge funds and money managers, they have yet again in the latest week, they've upped their net long positions in both gold and silver contracts in the latest week. However, on Friday we did see gold prices falling after they hit 6-year highs earlier on in the week of 1,557 US dollars per ounce. We've seen that pullback on Friday as a result of upbeat remarks from Federal Reserve Chair Jerome Powell, which offset a weaker than expected US non-farm payrolls earlier on in the session. In fact, gold prices so far this year have risen 17%. Meanwhile, oil prices also rose on Friday, breaking back above 61 US dollars per barrel after Jerome Powell, the head of the US Federal Reserve, said that central banks will act as appropriate to sustain economic expansion. So with that, let's go over to the charts and we'll talk you through what we're looking at as we go into next week. First of all, moving over to gold, you can see here where on Friday gold has closed at 1,505 US dollars per ounce. Now that is of course after we already broke above earlier on in the week 1,557 US dollars per ounce, which took gold prices up to 6-year highs. So as we discussed on last week's commodity report, you really wanted to look out for this fake out to the downside midweek here for gold prices, where we did see a correction back down towards the lower end of the range, only then to get bid back up, and we saw that breakout move taking the price back towards those 6-year highs. So we capitalized again on the breakout, but as always you want to make sure you are taking some profit off the table when we are getting these breakouts. At the moment we are seeing range bound trade in gold, and therefore banking profits at the upper end of the ranges allows you to then buy back in lower again and just take advantage of the ebb and flow of gold at the moment. Week to week at the moment, gold is moving within a 400 to 500 point range. You definitely want to capitalize on that, and of course over the last 3 months here we've continued to see gold break out to the upside, continuing to break out to 6-year highs. Therefore it's been more lucrative to buy into the dips as opposed to keep trying to sell into gold, which many retail traders, unfortunately, they keep on getting on the wrong side of gold, selling just as gold is about to break out to the upside. We've seen many of these false breakdowns in price, these bear traps, which only then turn out to have another rotation back towards highs here for gold. So as we go into next week, we're currently consolidating at 1,505 US dollars per ounce. As we mentioned the previous week on gold asset of the day, we banked profits, partial profits on the gap up on the open from last Sunday through to Monday, banking 500 points profit on a number of our positions, and then from there we've continued to buy in on these dips during the week, and then of course banking on the breakouts and then looking to then capitalize on the pullbacks. But that said, as we go into next week, we have settled at 1,505 US dollars per ounce. What I want to see certainly as we go into the Sunday and Monday open, first of all, is whether we do gap on gold and whether we do see some support come in during the Asia Pacific session. Usually the lows of the week, they get formed earlier on in the week for gold, unless we have a major news item like a non-farm payroll or the Federal Reserve speaking, although next week on Thursday we do have the European Central Bank announcement. So I want to watch the price action on Sunday through to Monday. Normally the lows of the week, they do tend to form earlier on in the week during the London session. You tend to see gold get driven lower during that session, and then we start to see buying come in during the US session and into the Asia Pacific session. So given where we're sitting at the moment, we do want to see whether gold is going to be able to hold above that 1,500 US dollars per ounce level and start to make a move back towards the midpoint of the range, which would take the price back towards the highs achieved after Friday's non-farm payrolls, where we did see initial breakout to the upside. In fact, we capitalized on that move, a quick 135 points on that move before then buying back in again on retracements lower back towards the current lower range. So now going into next week, we do want to monitor whether gold is going to be able to hold around the 1,500 level and then very simply have another attempt to drive back towards the upper end of these ranges and make a move back towards the 6-year highs. Now, if we then have a look at seasonality for this time of year, usually over the next 2 to 3 weeks, gold price gets well supported. We also had the Federal Reserve speaking on the 18th of September. We have the FOMC statement where the Fed are anticipated to cut interest rates. Hedge funds and money managers have also increased their net long positions in the latest week. So all of this does provide further support for the gold market. However, that's not to say it can't go lower before going higher. But we do have key support at the moment around that 1,500 level, and that's what we'll be looking out for as we go into next week. And then if we move over to silver, well, silver, you want to pay attention to the gold to silver ratio at the moment. The gold to silver ratio has in fact started to find some support here on Friday. We've seen a weekly close which is bullish for the gold to silver ratio, which suggests going into next week, gold is going to outperform silver. If we do see a correction, the pullback on silver will be more severe than gold, which is exactly what we saw on Friday, a 3% move to the downside for silver prices, whereas gold only pulled back 0.82% on Friday, which does suggest that silver is going to be more vulnerable to a correction into next week than gold. However, we do have that key magnetic level which resides at $18 an ounce. We'll be watching that level very closely as we go into next week. And of course, on gold as well, we want to watch that 1500 level, so 1,500 US dollars per ounce, to see if gold springboards off that level and whether that level does get defended going into next week, and we merely just see a rotation back towards the upper end of the range yet again. Now, many traders will be watching Thursday's European Central Bank announcement, which of course can be a big catalyst for some very large moves, and then the focus will all shift to Wednesday the 18th of September, which is the FOMC statement. So you want to have those dates very clearly in the diary too. So with that, let's just move over to crude oil, because many of you have been in touch with regard to the crude oil prediction that we made last week when we were going through the ranges for the week ahead and really the levels that we were looking to buy into and then capitalize on a rotation back towards the upper end of the range. So essentially what we were waiting for last week was a retracement back towards 53 US dollars per barrel, which is exactly what we saw at the beginning of last week. So we saw from the Sunday through to Monday, of course, that US had put their tariffs on China, and with that we did see a gap down on the open for oil, a rotation back towards the 53 US dollar per barrel zone. We were looking at evidence of support to come in at that level, and then we bought in via Brent crude oil, which we found had a better risk to reward, where it was sitting just below that 58 US dollar per barrel handle. In fact, we banked over 350 points profit within 24 hours on our oil position last week, with this dip lower at the beginning of the week and then breakout back towards the upper end of the channel. So feel free to go back and watch Oil Asset of the Day that we put out on our YouTube channel midweek, and also the previous week ahead report where we had discussed that we were looking for a move back towards the lower end of the channel around that 53 to 52 US dollar per barrel zone for WTI crude oil, and the equivalent on that on Brent would be a move back towards that 57 to 58 US dollar per barrel handle. Look for evidence of support and buying to come in, and from there we've springboarded higher, and we've in fact broken above $61 per barrel on Brent crude oil. So well done to all of you who did also capitalize on that breakout move last week. That worked perfectly for some really fast profits. And again, as we mentioned last week, oil does tend to get very well supported over the month of September. We've already seen a strong rotation back towards the upper end of this range here. So what we're going to do going into next week, we're going to keep our long position on oil running with a view to see if we can get some further upside as we go into next week. And still, if you were to get further pullbacks back towards the lower end of these channels, again, we would look at those as potential buy opportunities, although we may not see that happen again going into next week. Given that we are at the upper end of the range at the moment, we'll be looking for further breakouts. So we're looking to manage this trade and just remain in our long position going into next week and see if we can tap the upper end of these ranges for both WTI crude oil and also Brent crude oil, which you can see as well. If we go over to the weekly chart, we've had a bullish engulfing candle on the weekly chart, closed at $61.60 per barrel. So we will see if we can get a rotation back towards the 62 to 63 level as we go into next week for Brent crude oil. So going into next week, overall we're looking to stay long on our crude oil positions. As I mentioned, we banked a lot of profits on gold in the previous week, banked 500 points just from the Sunday through to Monday open. We've also banked gold on these range bound trades where we're buying back in at the lower end of the ranges, and then we're just capitalizing on these breakouts back towards the 6-year highs, but being careful, of course, as always, not to FOMO in. So where a lot of traders are getting it wrong right now is many traders out there, they won't buy on these dips with gold. They tend to try and sell when we're breaking back down towards the 1500 levels, and they get caught on bear traps only for the price to then break out. They get caught in a short squeeze, and then just as the price is breaking out, breaking above the recent swing highs, 1,550 US dollars. Many inexperienced traders are then getting FOMO, the fear of missing out. They're buying too high only to then get stopped out again, as the price cannot get above that level at the moment. So you've got the case right now where many retail traders or inexperienced retail traders, they're selling right at the lows, they're getting squeezed out, and then they buy right at the highs, and they also get on the wrong side of the position. So really the optimal way to be taking advantage of this at the moment is making sure you're taking some partial profits as we get those breakouts on both gold and silver, and that enables you to then day trade gold and have swing positions on gold, where because you've taken some of your profits off the table, you then buy back in on the pullbacks. And this has been the case over the last 3 months. We can capitalize on this with hedge funds and money managers continuing to accumulate their net long positions. We're in a seasonally bullish time of year. We're anticipating the Federal Reserve to cut interest rates as we go into the September FOMC statement. However, you do need some experience in trading gold in order to really capitalize on these moves that we're seeing on a regular basis. And with that, that's where a research-driven process will very much give you an edge in the market. So it's not just about doing pure technical analysis. You really need to marry that up as well with what the smart money is doing in the market versus retail traders, overall market sentiment, making sure you're on top of geopolitical news, trade flow, and then using market intelligence, and then marrying that up with fundamentals, correlations, seasonality, cycles which occur during the week, during the month, and also during the quarter, and then generating a trade idea which gives you edge in the market. So with that, if you would like to join a community of successful traders and learn a research-driven approach to the markets, of course, there is an opportunity for you to join us at the Gold and Silver Club. Members get access to our exclusive live trading room webinars. You have access to real-time trade alerts, real-time trading research and market insights, access to our private members academy membership site, and also support and one-to-one mentoring. For more information about the service, just go to www.jointhelivetradingroom.com. The link is also below this report in the description, so just click on the link, make an application, and we will of course get in touch with you ASAP. And do make sure you subscribe to our YouTube channel. That way you're always kept updated with all of the latest commodity reports.